Hi everyone, welcome to a new video. Today I'm going to be discussing a general investing topic, liquidity to be specific. And I want to go through this just because it's quite a divisive topic at times, whether a share has enough liquidity for you to buy in. Obviously the level of liquidity affects how the price can move, the volatility, especially on big news. And that's important if you're a small investor, if you're, really trying to ensure that your capital lasts, that you're not wiped out of a position. It's important to consider things like liquidity. So the company I've got up in front of me here, DP Aircraft, listed on the London Stock Exchange, but in the special funds area. And this is something that a business I'm fairly interested in. The reason being is because it's got a lot of cash, great elements to it, but also a lot of problems. One of which is low liquidity. And the other is more separate, but that's not really the topic of this video. But they've basically got, they lease aircraft basically for a profit. And obviously that's not a great industry right now. And their two lessees are in a bad way, especially Thai Airlines. Anyway, moving on from that, back to liquidity. Let's talk about why it's a problem. So liquidity is problematic because, say you're looking at this share price, this kind of massive fall over COVID is kind of, happened to a lot of stocks, but a lot of stocks have now recovered. This one hasn't because of its industry. But that can be exacerbated with a low liquidity stock because there aren't as many people out there that own it. And often these particular companies, they're owned massively by institutions. If you look at that there, 66.8% owned by institutions. That's a lot. Some big positions from certain investment companies, 25% from M&G. And that can be a problem when, say, you get a new piece of news. Those institutions are probably going to move quicker than you. They probably have the ability to move quicker than you. Often these trading platforms, they aren't prioritized. They're behind in the trading queue, in the ladder, that kind of thing. I think a lot of people experience that with Cineworld this week, where they didn't sell out until the very bottom. I think you find a lot of that is selling prioritized by institutional clients rather than those deals being found for the retail clients. And also for that, you have maybe selling the information there, causing certain hedge funds, certain businesses to short the company as retail investors are trying to break out. In the Cineworld case. But in this particular example, liquidity could be an issue because it's it's two-thirds owned by institutions, so they could sell out of their huge positions and have a huge effect on the stock. Obviously, there's not much downside left in it. It's trading at about 8p a share, $16 million market cap. If you look here on the London Stock Exchange website, you can see that it's had not that many trades, so 4 trades today, and then before that it was a 6th, and obviously that's not only difficult to buy into, but also difficult, when you're looking to sell out, especially in a panic scenario. Now, for me personally, I'm not sure this is a huge issue if you have a high conviction on the company. There are examples where it's gone terribly wrong last year with Burford, that whole thing where he bought into a lot of low liquidity stuff. It got shorted to hell. He lost a lot of money. But I think as a retail investor, you're not really at risk of someone. You are not at risk of someone finding out your positions and shorting you. No one is going to earn that much money that way unless you're taking out millions of pounds worth of positions, which, to be honest, most people watching this video will not be, if not all of them. I'm certainly not. Maybe one day, though, hopefully. But yeah, so I think, you have to think about it in terms of the risk reward. Now, obviously, also with this kind of illiquid share, you can get a big spike in the share price too. If people see good news, they will buy in. It's again a liquid, so there's going to be bigger price movements, which is good as an investor. So yeah, I would say it's, for me, not a reason not to buy stock, but it's definitely something to consider. I definitely would be careful on the position size you take in this kind of stock. You can see here in these recent trades that there are not massive in value, $180, that probably is, sorry, yeah, dollars, $1,800, $2,000, $8,000, etc. They're not massive. So that's just something to consider when you look at companies like this. I mean, I heard a good thing from someone, look at the daily volume and buy 10% of that if you're that big of an investor, and that way you can ensure that you can get out of the position. So beyond that, JSmart, another one that's very interesting, another company that I like. But again, it suffers even more from a liquidity problem, shall we say, a liquidity problem. You can see here one trade on the 8th, two on the 7th, 6th, then the 6th and the 5th. Like that's, again, a long period of time between the last 5 trades over 3-4 different days. So you've just got to bear that in mind. Again, it's not a reason why I wouldn't buy a company, but you can see here it's very blocky. That's because it's so illiquid. Not getting as many trades, so when there's one change in price over a day, it makes a huge difference. It makes it blocky, effectively. So that's just something to consider when you're looking at these small companies that are thinly traded. Again, it wouldn't stop me buying them. I think that's important to say. But I would want a higher conviction level. This isn't something where you can, let's say, take a position before earnings because you think earnings are going to be positive. Not that I'm recommending you do that, but if you did trade like that and you took a position before earnings, you thought they were going to be positive, in this kind of situation, you're not going to get out of that position quickly if it all goes wrong. So it's not the kind of company you want. Personally, for me, though, these two do offer great value. I'm going to keep looking at them, keep analysing them and see whether they are worth the investment, worth that added risk with the liquidity. But yeah, that's just a topic I wanted to delve into. I might do a few more of these videos delving into certain investment topics. I think that things like that are very interesting, especially when it comes to liquidity, because it can be such a killer on a return. And especially when things are going wrong, things can go really wrong if you had liquidity issues. Less so as a retail investor, because obviously you don't have investors coming to you trying to take their money out, which is obviously part of the problem in the Burford example. So yeah, if you're high conviction, if you're sure you're going to hold on to these things, you're really keen for the future of the company, confident, see that they offer great value, then I think it's worth it personally. Obviously, that's down to an individual basis. You need to make your own assessment on it. And as usual, this is not financial advice. Do your own research, form your own opinions before investing. But yeah, I wouldn't be put off by liquidity, but I'd just have it there as a thing to remember, a thing to be aware of. And it might, dissuade you from a certain stock over a different one. But I wouldn't be scared of it. I think it's something you can manage. Obviously, you don't have a portfolio full of illiquid stocks, but I think you can have a few, 1 or 2, depending on the size of your portfolio. I'm looking to hold about 20 stocks, so 1 or 2 wouldn't be that big of a deal. 1, 2, maybe 3. So yeah, that's my 2 cents on the topic. Thank you very much for listening. Please like and subscribe if you enjoyed, and thank you very much again.